Most businesses waste $40, 000 to $100, 000 yearly because they don't know their credit card is a negotiation weapon. But today, you're learning the insider move that cuts vendor costs by 40%. I'm going to walk you through the exact framework we use to turn purchase protections, extended terms, and cashback benefits into legitimate supplier discounts that your competitors don't even know exist. Pattern interrupt 1 before we go further. If you're running any kind of B2B operation and you're not auditing your vendor contracts annually, you're literally leaving money on the table. And by the end of this video, you'll understand why. Let's start with the core insight. Vendors negotiate based on what they think they have to lose. Most business owners only negotiate on price. But you're going to negotiate on 8 different vectors simultaneously, and your credit card is 3 of them. Here's what vendors don't expect, and this is where the real edge is. When you pull out a premium business credit card, American Express Corporate, Chase Inc. Preferred, or Stripe Business, most suppliers still think of it as just a payment method. They don't realize you're sitting on extended payment terms, purchase protections, travel insurance, and category bonuses that create immediate cost reductions they can't see on an invoice. Pattern interrupt 2, let me give you a concrete example. A SaaS company we worked with was paying $80, 000 annually to a software vendor. Same vendor, 3-year contract locked-in rate, but here's what changed the negotiation. They switched to paying via Amex Corporate, which gives 3x points on software subscriptions. That's $400 in annual cashback. But the real leverage wasn't the cashback, it was what they said next. We're moving to Amex Corporate for this category, which means extended payment terms and purchase protection. We'd love to pass some of that benefit to you in the form of a 2% volume discount, or we stay with the vendor's standard billing. The vendor took the deal. $1, $600 annual savings plus $2, $400 in rewards. But the psychology, they made the vendor feel like they were getting something, faster payment certainty and reduced chargeback risk. Total win, $4, 000 on $80, 000 spend. Pattern interrupt 3, now let's talk about the framework itself, because this only works if you do it systematically. Step 1, conduct a vendor spend audit. Pull every vendor contract and payment over the last 12 months. Segment by category: software, shipping, manufacturing, contractors, travel, office supplies. You're looking for vendors where you have repeat, predictable spend. These are your leverage points. Most business owners skip this step. Don't be that person. Step 2, map your credit card benefits to each vendor category. Here's the cheat sheet: software and cloud services. Amex Corporate gives 3x points. Chase Inc. Preferred gives 3x on internet, cable, and phone, which covers Zoom, Oz, G Suite infrastructure. You're automatically creating 2-3% rebate value before any negotiation. Shipping and logistics. American Express gives 3x on shipping. Chase Inc. has 2x on shipping and fuel. FedEx and UPS contracts. You're already creating 2-3% value. Manufacturing and supplies. This is where category flexibility matters. If your vendor accepts corporate cards, you're looking at extended payment terms, usually 30-45 days interest-free plus purchase protection. That's real leverage in a negotiation. Pattern interrupt 4, here's what most people get wrong. They think the cashback is the negotiation tool. It's not. The cashback is the sweetener. The real tool is the combination of benefits. When you negotiate with a vendor, you're actually creating a value package. Extended payment terms, 30-45 days instead of net 15, equals vendor gets better cash flow forecasting, purchase protection. If goods arrive damaged, Amex covers it, equals vendor gets reduced chargeback risk. Dispute resolution, Amex backs your claims. Not the vendor, equals vendor avoids lengthy disputes. Cashback/rewards equals you invest some of the savings back into the relationship through improved payment reliability. Vendors see this as risk reduction. You see it as a negotiation win. Step 3, build your negotiation script. Here's a template that works. Hi vendor, we're restructuring our payment infrastructure and consolidating to corporate card payments for category. This gives us extended payment terms and fraud protection, which we want to pass to you in the form of a modest volume adjustment. What discount would make sense if we guaranteed 100% payment reliability and eliminated chargeback risk? Key phrases: restructuring our payment infrastructure equals makes it sound systematic. Not desperate. Corporate card payments equals signals you're legitimate and organized. Payment reliability equals vendors care about this more than you think. Eliminated chargeback risk equals this is huge for vendors. Most don't advertise it, but chargebacks cost them 2-5% of transaction value. Pattern interrupt 5, you'll get pushback. Vendors will say we can't discount for payment method. Here's your response: I understand. What we're really asking is whether a longer payment window, say net 30 instead of net 15, works for your cash flow. That's often worth more to us than a direct discount, and it doesn't come off the invoice. Extended payment terms are incredibly valuable. If you're paying $10,000 monthly, moving from net 15 to net 45 is an extra $20,000 in working capital. For 12 months, that's $240,000 in improved cash flow you can deploy elsewhere. Step 4. Stack the benefits. This is where most people miss the multiplier effect. You're not choosing between cashback or extended terms or purchase protection. You're getting all three. Then you negotiate on top of that. Example, a manufacturing company paying $500,000 annually to a supplier. Using Chase Inc. Extended, they get 2% cashback, $10,000, extended payment terms, net 60, and purchase protection. During negotiation, they asked for a 1% volume discount, $5,000. Vendor agreed because they saw reduced operational risk and improved cash forecasting. Net result, $15,000 in combined savings plus better working capital. Pattern interrupt 6 now, the credit score question. Everyone asks, won't this hurt my business credit? No, here's why. Business credit utilization works differently than personal credit. Most vendors report to Dun & Bradstreet, not the traditional credit bureaus. And unlike personal credit where 30% utilization is optimal, business credit bureaus favor active credit usage. They want to see you using credit responsibly. The key is payment consistency. Make every payment on time, every time. Your business credit score will actually improve because you're demonstrating reliable behavior across multiple vendors simultaneously. One caveat, don't max out cards. Aim for 30-40% utilization across your entire corporate credit portfolio. This shows you have capacity and are using it strategically, not desperately. Pattern interrupt 7, let's talk about what happens when you scale this. Imagine you have 15 vendors. You implement this strategy with 5 of them over 3 months. Conservative estimate. 1. 5% average savings across $2 million in annual spend. That's $30,000. Now scale to 12 vendors over a year. You're potentially looking at $60,000, $80,000 in combined savings from vendor discounts, extended terms, and reward stacking. For most small to mid-market businesses, that's 10-15% of net profit. It's not trivial. And here's the thing, vendors don't lose money. They just shift their margin allocation. You're not destroying their economics. You're optimizing your negotiating position based on the full value you bring to the relationship. Pattern interrupt 8, let me give you one advanced move most people never think of. Vendor relationship layering. You negotiate with your primary vendor for better terms, but you also evaluate their competitors. You don't switch, you just let your primary vendor know you're evaluating alternatives. Now you're not negotiating from weakness. You're negotiating from the position of someone who has options. It works. Vendors would rather keep your business at slightly better terms than lose you entirely. Okay, here's your action plan for this week. 1. Pull your last 12 months of vendor spend. Yes, actually do this. 2. Identify your top 10 vendors by monthly spend. 3. Cross-reference with your corporate card benefits to find overlap, software plus 3x categories, shipping plus 2x categories, etc. 4. Schedule calls with 3 vendors where you have the most leverage. 5. Use the script I gave you. Adjust for your industry but keep the framework. Start with the easiest vendor. Win a small negotiation first. This gives you confidence and proof of concept for bigger vendors. Final pattern interrupt. Here's what separates businesses that do this from those that don't. Intentionality. Most people stumble into vendor negotiations reactively when a contract's up for renewal or when a vendor reaches out with a rate increase. You're going to do this proactively, systematically, and based on the actual leverage you have. Your credit card isn't just a payment method. It's a negotiation